Can you walk us through typically how D&O coverage typically shifts from the IPO to de-SPAC and then post-closing? And how would a SPAC need to what do they need to do to avoid gaps and any coverage during that period?
Sure. So there's sort of the historical way that it's been done, and then there's the new, better mousetrap that we actually created a few years ago for the de-SPAC as well. So in the old days, you would buy a D&O insurance policy for the SPAC at the time of IPO. It would bind, 12:01 a.m. on the day that you price and list. And that policy can either be what we call ABC coverage, which is securities claim coverage for the SPAC entity and sponsor, and coverage for the officers and directors, whether or not indemnified, or it can be side A only, which means that it's just personal asset protection for the officers and directors. These days, it's much more common for a SPAC during the search period post-IPO to just carry a side A only policy because the risk environment is pretty benign. But then when you get close to the de-SPAC transaction, you build an entirely different program. In the old days, you would buy runoff coverage for the SPAC, which is a 6-year extended reporting period for any claims that come in after de-SPAC, and you would build a separate program for the target company on a go-forward basis as a new public company. What we created a few years ago was something that we like to call the DeSPAC-age, which is one policy that provides coverage both for the SPAC on a runoff basis and for the target company, both as a private company and a go-forward public company. The reason is typically all those entities and individuals get sued together. So why not have a policy that covers everyone together? And it also reduces cost, reduces retentions or deductibles. And it also has the nice feature of making most of that insurance premium financeable. So you can spread the cost over a year as opposed to paying it one time.